Ladies and gentlemen, please welcome to the stage Ken Caplan and Alex Costa.
Welcome, everyone. Ken, thank you so much for coming.
That didn't really manage expectations very well with that build-up. But thank you for having me. It's
awesome, and we had such a great conversation over dinner last night, and I realized that we could sit here and talk for literally hours. So we're going to have to move quickly through this. But first, let's start. Let's learn a little bit about you and your background. Your father, I think your grandfathers were home builders in small town New Jersey, where you still live.
Yes.
Real estate is kind of in your blood, I guess, to some extent. But what attracted you to move into that as a career?
Sure. First, let me just say thank you, Alex, to you and Prime Quadrant. You've been great partners and obviously great to be here today. You've got quite an impressive lineup. And, I'd say despite that buildup that I just got, when I was with my family, I do have two boys, one in college. We were all together this weekend, and we're talking about our week ahead, and when I told him I was coming to Toronto, why are you going to Toronto? I'm speaking at this conference. What's it about, investing? And then I said, I know how to get interest, because as you said, I live in suburban New Jersey. It's New York Giants, town. My entire family, including myself, Giants fans. I said, Eli Manning speaking at this conference. All of a sudden, I went up a few notches in credibility in the family for like 2 seconds until my son in the same breath said, well, what are you going to talk about? And I said, well, they want to hear what we're doing as well. So hopefully I can provide a little bit of insight into Blackstone, what we're thinking.
Well, your reputation has definitely built up this morning. LT said many kind things about you already.
Yeah, LT is awesome. I mean, we worked together for many years, and that's what happens when you're at a firm for 27 years.
I mean, on the way out, he said to me, Ken is the quiet force behind Blackstone.
Oh, yeah. So I don't know about that.
Lots of about.
But anyway, my background, I did grow up in suburban New Jersey, and quite boring. I live in the same town, Short Hills, that I grew up in. And my dad was a local home builder, as was he was third generation. Still feel a little guilty in breaking that chain of
They'd be
home
proud,
building.
Ken.
But I appreciate that. But I did grow up around it. I mean, when you're a local home builder and you grow up in that family, and there are floor plans all over the house, and I thought it was normal weekends getting in the station wagon and going to job sites and, climbing through half-built buildings and working summers and, framing houses in mason work and even architecture school for summer. And that definitely planted a bit of a real estate seed in my head. And I didn't really think I was predestined to do that, but that certainly has evolved, and it's been awesome to have, basically, until this year, the entirety of my career, fully planted in real estate. But actually, it's more than the real estate side, though. I'd say, the way that my father, loved what he did and had great pride in what he did, as, even though he's third generation as a home builder, he didn't get any business handed to him. He was around the same environment that I was growing up, but he was very proud of that he built this business on his own. And home builders do not necessarily have the best reputations, but he built in the neighborhood that we lived in, as did his father and his grandfather, who came over to the United States, with nothing, like a lot of immigrants did. And but he was really proud, and nothing made him happier than opening up the paper on the weekend and seeing someone list a house as a Caplan-built house. And so that pride in what he did, the love of what he did, his reputation, no business got handed to him except the name. And so, how important that was, and how he was all in. He brought work home. There was no real division. He was a great father and there for all the games, but he was also all in work. And as much as the real estate got planted, I think that whole mindset of work, and that you can be there for your family and be all in on work and love what you do and really be passionate and do a great job and be very proud. And, I think that is a lot of the reason why, I do what I do, and I've been at Blackstone so long, and it aligns with how we, approach our jobs, and, really trying to be the best at what we do, and really proud of how we do things at Blackstone.
That's tremendous. I mean, 27 years is a long time. So, to be successful in a firm like that, ability, essential, drive, determination. What else does it take to be successful in a firm like that over nearly 3 decades now?
Yeah, it's 20. It is a long time. At some point, you feel like you're kind of part of the wallpaper. But it's been amazing. And I mean, when I started, the firm was obviously a lot smaller. But the core of who we are, some things have obviously changed. Obviously, this over $1 trillion of AUM, very different when you have a couple $1 billion of AUM, like when I started. But the core of who we are in terms of work harder, care more, our reason to exist is delivering the best returns possible for our investors. Whether it's the couple of strategies that we had in 1997 when I started, or the 60+ strategies that we have today. And in order to and we're like John Gray and Steve Schwarzman would say, we're like the restaurant business. You're only as good as the last meal that you serve. And so you got to keep delivering, great experiences and great, food for your customers or for your guests. And at Blackstone, what that means is working, really a central tenet, working harder, caring more, also working as a team. I mean, it is a team sport at Blackstone, accomplishing things together that no one person could accomplish on their own, and being part of something that's kind of larger, and also being very adaptable, I'd say. Our business, has not just grown in one vertical. It's grown in both scale and scope of what we do. And we're nearly 5,000 people today, but we still view ourselves as as a startup in a lot of ways. And we still see the opportunities ahead of us as being actually larger today than they've ever been. But in order to do that, you really have to be how can we evolve? How can we innovate? How can we be better? And really having that mindset of no complacency, right? In our business, you can't be complacent. What worked for either our business or in the world as an investor 10 years ago is probably not going to work today, and what you're doing today is probably not going to be working 10 years from now. So how can we continue to innovate? How can we continue to stay ahead? And you really have to be up for that and excited by that. I personally love learning. I love meeting new people. I love trying to figure out new opportunities, where there might be changes happening. And one of the things that to me is really exciting about the current environment that we're in is there's just so much change happening. And at Blackstone, we just have so much data to see that change happening and see it earlier. And that really guides, I'm sure we'll talk about how we invest.
Yeah, no, so I mean, that leads nicely into, Blackstone started 30, 40 years ago as a small private equity consultancy, moved into real estate. And over the years has expanded to become leaders in these areas, huge, maybe the leader in areas like private credit, data centers. What was the thinking behind going into those businesses, and what are the synergies that you've been able to harness by going into these?
Sure. So, as large as we are, and I apologize, some of you might know us better than others, but as large as we are, we're highly thematic investors. And that's something that we've learned over many, many years. And again, if you go back to when I started, and a bit of a history on Blackstone, really up until the financial crisis, we were an opportunistic investor. And we were mainly in 2 areas. In private equity, initially in private equity. We had actually we had an advisory business as well that we ended up spinning out and is now a separate company called PJT. But we were in the private equity business. And then in 1991, we started investing in real estate. And in both, it was opportunistic. Buy the empty office building, lease it up, sell it. Buy the undermanaged hotel, fix it up, improve operations, and sell it. And similar things with companies in the private equity space. Close-end funds, higher targeted returns. And that was really what we did. And we evolved in terms of small individual assets, portfolios. In terms of innovation at the time, it was seeing that public companies were trading below the net asset values, so finding some public companies that we could buy in the real estate space, financing it with real estate debt. And that was an evolution as we got larger in those verticals. Post GFC, we got more significantly into the credit business. We bought this company, GSO, but initially that was also more of a distressed or opportunistic credit business. As interest rates came down post GFC, and as we looked at this infrastructure that we had built up then, in 2008, 9, 10, post financial crisis, lower rate environment, we had built these capabilities, in the US, and we had expanded into Europe and to Asia on the opportunistic side. we saw that we had the opportunity to expand what we did, not just in this opportunistic capital, but also into core and core plus capital. Initially for the same institutional investors, and now more recently in terms of insurance capital and individual investors, and designing strategies that really were, same type of thematic, same process, same commitment to excellence and doing the best job we can, but for a wider group of investors, leveraging all that we had built, all the lessons that we had learned, all the processes that we've continued to evolve. And that's opened up just lots of new opportunities for us. In real estate, we have institutional core plus funds and also areas like infrastructure where these are more core plus type assets, which really weren't as much of a fit for our old opportunistic business, but now is a real great fit and a super exciting area to be in. And infrastructure, which we have direct infrastructure fund, a secondaries infrastructure fund, which I know not a lot of your clients are invested in, which has done great. And one of the nice things about Blackstone today, and a big reason for my role, again, I'm co-CIO, and a little bit of my history of the 27 years is real estate for that time. In the US, I ran our Europe business for a few years. They created a new role as CIO of real estate when we're really trying to connect all of the information we're getting around the world in real estate to make sure we're capturing all the benefits of what we're seeing in terms of trends. I co-headed real estate for 6 years, and then this year became co-CIO. The first time we've had a CIO at the firm level also. And it's the same thing, connecting the dots, seeing the trends, because one of the reasons we are so excited about infrastructure and private credit and private equity and real estate is these mega trends where we're investing today really transcend the businesses. We'll talk, I'm sure, about AI and what we're doing in data center space. That's in real estate, that's in infrastructure, that's in our credit business, and then there are derivative investments in our private equity business as well. And being able to see that in one area and then connect the dots across the different businesses and say, what might we be seeing that others aren't seeing, and then invest into that is really important. And if you look at how our investing has evolved over time, you can see how you can really see how important that is to have that feedback looping connection. Because again, when I talked earlier about what our business was in real estate, it was literally hotels and office buildings, right? And US office buildings, which are not in vogue today, right? US office buildings pre-GFC were over 60% of our global real estate portfolio. And I can tell you that if US office buildings were over 60% of our global real estate portfolio today,
we might not be partners.
I would not be at this conference. Or at least it would be a very different discussion. But US office buildings are today less than 2% of Blackstone's global real estate portfolio. And we've really been de-emphasizing US office buildings. We did something similar in shopping centers. We have not bought a traditional US shopping mall in the US in well over a dozen years. And why is that? Well, post GFC, we started to see we actually bought some warehouses, very attractively priced. And when we bought those warehouses, which was, the GFC was a classic real estate crash, right? A lot of lending in 2007, a lot of development, a crash in the economy, lots of vacancy, lots of distress, and then we're buying a lot of things really inexpensively. One of those things was warehouses. At the time, warehouses were maybe 1% of our portfolio, almost nothing. But what we quickly saw is the new supply basically stopped, and the demand for those properties was much stronger than we had anticipated. So we looked closer into that. What's happening? Well, Amazon and other e-commerce tenants were starting to lease space and really changing the whole utility and attractiveness of this asset class. And from 2010 until today, logistics have gone from, again, less than 1% of our portfolio to over 40% of our global real estate portfolio. And that, started in the US. I was actually in Europe at the time, and the way our business is connected, I said, okay, that seems exciting. We didn't think it was so exciting here in Europe. Maybe there's the same backdrop. Yes, there is. Okay, let's do the same thing in Europe. Let's do the same thing in Asia. Let's do the same thing in Canada. We privatized a company, Pure Industrial, which has been a fantastic success for our real estate business. And let's lean into that. And let's lean into what other opportunities might exist. Same thing with rental housing as a shortage of housing. Same thing happening today in the data center space. So you see a bit of that evolution. John Gray gets a lot of credit for really connecting all of that real estate business and now really focus on connecting the entire firm.
So let's maybe hold that thought. So, you have all these different businesses, thousands of different portfolio companies across the world. You've got all this data coming up, but all of the work you're doing is underwritten by valuation, right? But you need to have a macro view to inform a lot of the work that you're doing. What are your high-level thoughts on the economic outlook, growth, employment, inflation?
So we spend a lot of time on this. One of our advantages today, which was not the case when I started, was given the size that we are at today, we get a lot of data, right? As the largest private equity investor, the largest commercial real estate owner, one of the largest private credit providers, we have almost 13,000 real estate properties. We have 230 or something portfolio companies. We have thousands of borrowers, and we get data coming in from all of that. And it really informs views on both the macro side and within geographies and sectors. And that is a really important feedback loop that, as I mentioned on logistics or rental housing, data centers, really feeds into what we're investing in.
Maybe just touch on what sort of data, just for the benefit of everyone. Like what kind of data are you
doing
that's particularly instructive in informing a macro view?
So if you want to start on a high level on the macro side, things that we'll look at is we'll look at across our portfolio companies. What's happening? If you want to look on the expense side, what's happening in input costs? Have a view on inflation. And what we've been seeing actually for 5 quarters now, for over a year, non-labor input costs are running at less than 1%. In our portfolio companies. That tells you something about what's happening with inflation. What's happening with the 2 big holdouts on inflation in the US, I think a bit here as well, in Canada have been shelter and labor, right? And what do we see in labor? Well, we've seen wages continue to tick down in our portfolio companies as well. They've just ticked below 4% for the first time in a while. And we also survey our CEOs and say, what's your outlook going forward? And they're now saying going forward next year, we see that as being even lower at 3.5%. So we've seen these input costs low. We've seen the wage growth coming down. And every time the US inflation numbers come out, we dissect all the different components, what's happening. And we know the biggest driver of inflation, which has all come down meaningfully, but what had been and continues to be the biggest holdout is now shelter. Shelter is pretty known now to come in on a lag the way they measure it in US inflation. We have, I think, better data than anyone on what's really happening in terms of shelter costs. And while it's coming in around 5% in the official numbers, we know that it's less than 2% in the real numbers. So that would tell you, and you can look at these analyses that lag the shelter number and a trend to where inflation's going. And that, between the input costs and the wage trends and the shelter costs can give you a view on where you see inflation going. And at the beginning of the year, even, we saw these trends starting to happen. And it did, if you want to go back to real estate as an example, where there was so much negative sentiment for the last couple of years on real estate, mainly because you had interest rates going up, a lot of press on how difficult office buildings are, which is really challenging. Commodity office is really hard. But that put a really negative sentiment on real estate. And when we saw a separation between what's happening in office, what's happening in other areas which are much healthier, and we started to have this confidence of inflation coming down and, not necessarily betting on timing, but a direction of travel of rate cuts coming. At the beginning of this year, we said, we see real estate values bottoming, and we think it's time to invest. And we didn't just say it, we did it. I mean, our year-to-date real estate investing this year is 2.5 times what it was last year. And it's not just real estate. Our private equity and credit deployment has been, I think, a record this year at Blackstone. Actually, in last quarter was our highest quarter of deployment in over 2 years at the firm. So, that's what we saw. It gave us confidence to invest. Again, we don't just sprinkle it around. We're not an index fund. We're highly thematic. And in the areas where we had that confidence and conviction, combined with what we're seeing on the macro level, it gave us the confidence to invest. So we see that. And then we see it on the sector level also. Every week I'm getting a dashboard that shows our apartments and then the new lease rents versus the the expiring rents on a renewal, on a new lease, what's happening with occupancy, what's happening in each market. When we're seeing an opportunity to buy another apartment building in Atlanta like we did this week, we're looking at all the things we own around it. What are all the trends? What are all the population trends and occupancy trends? And that gives us a lot of confidence in terms of investing. And then like the ultimate is like when we see these very big trends, like what's happening with AI and data centers and demand, it says, okay, this is something really big, really structurally shifting, and how can we get ahead of this and use our advantages and our scale and our expertise and our relationships to really lean in ahead of the market and deliver across the firm.
So let's drill into residential real estate a little bit. So many of our guests here today have been very successful in residential real estate. Multifamily has been a big part of many people's portfolios. How are you approaching that space? What are you seeing as particular areas of opportunity, risks? And then maybe some of the themes that we've seen over the years. We saw the Sun Belt theme.
Sure.
Any concerns around any of those? I think of like Florida, where maybe some of these extreme weather events are making people think twice about going. The valuation differential has maybe closed a bit.
Sure. So again, just to maybe put it in context a little bit, I mentioned how we shifted from office buildings to logistics. And it's not just logistics. We still invest across a lot of different sectors, but the three biggest themes at Blackstone real estate right now: logistics, rental housing, which includes apartments, single-family rentals, student housing. We're the largest student housing owner in the US and in the UK, and affordable housing. And so if you take logistics, if you take rental housing, and you take data centers, that's 75% of our global real estate portfolio. So again, really focused in these areas because this is where we see, I mentioned on the logistics with e-commerce, rental housing, which is a shortage of housing. Now, what we've been seeing more recently is, unlike the GFC typical real estate cycle where you had all this exuberance, lots of overbuilding, really elevated vacancy levels in across the board in a lot of sectors. In this last cycle, you would have normally seen that start to take off when COVID shut everything down, and then you saw it take off a little bit when rising interest rates and made everything and inflation made everything more expensive to build. And that window when things were getting built a couple of years ago is now delivering. So one of the reasons we like the rental housing space, and it's different from the condo market. We don't really do for sale, and I know there's a lot of condos and high-end condos that have gotten built here in Toronto, and that's a different, a different beast than I'd say the rental space. But the rental space, you're seeing deliveries now that are elevated and that have softened the market. That's partly why you're seeing rents, which had been growing very strongly in the U.S., now baked to almost zero or very low levels, and same thing here in Canada. The rental growth has really stopped and been even negative in some areas. But when you're looking at what's happening today, it's a bit backward looking in real estate. And one of the nice things about real estate is you can't just print the buildings, you have to build the buildings. You have to get them entitled and financed and built. And that what's delivering today was actually started a couple of years ago, and what's starting today is going to be delivered a couple of years from now. And one of the things that we really like about the apartment space, the rental housing space, is that, and actually it's broader across a lot of the real estate sectors, is that the vacancy levels are still around, mid-single digits, 4 or 5%, and the supply, which is elevated, demand is keeping up with, and the new starts today, which again are going to be the deliveries 2 years from now, are down 40 or 50%. 40% in the US, I think it's around 50% here. So if you say, okay, I don't have this excess vacancy to work off, the demand's keeping up mostly with current supply, that demand, seems like it's going to continue, particularly since even though affordability is a concern, the affordability to rent is much better than to own, right? We look at cost to rent versus cost to own, and because home prices have gone up so much, because mortgage rates are higher, it's pretty record affordability of renting versus owning, and it really doesn't pencil to build apartments today. And because of that, you're seeing the supply come way down. So you can say, okay, we're in a bit of an equilibrium today. A couple of years from now, you're going to see half as many apartments delivered as you're seeing today. That's obviously a very positive place to be from a supply-demand dynamic. And by the way, it's the same thing on the logistics side. And then you asked about, Sun Belt. I mean, we do continue to see, Texas and Florida is getting, strongest population growth in the U.S. and those places, population growth and job growth and economic growth drives demand for apartments. And so, we're still positive on those areas, but I'd say broadly, with the shortage of housing, and particularly the relative affordability, and more people renting, whether it's more affluent or later in life, or even younger renters staying in place, we see this as an area that's exciting to be in.
Superb. Yeah, no, certainly an area we continue to be excited about. Switching gears to private credit. So that industry has grown from tiny numbers to almost $2 trillion today. I think Blackstone is one of the leaders, if not the leader. There's questions around, is this space too big? Can you continue to grow and deliver the sort of returns that you have? Any minefields that investors should be looking out for in that space?
Well, private credit has definitely grown quite a bit. And $2 trillion sounds like a lot of capital. But when you think about what's happening in private credit, we do see a real structural shift happening. And whether you look at like M&A activity or financing the real economy, or now not just non-investment grade, but investment grade direct lending, where John Gray will say the farm to table model, we just see a big shift in opportunity. And $2 trillion, again, sounds like a lot, but we see it as a $25 to $30 trillion market. So we see it as actually early stages. We still see, because I sit on the credit investment committees now as well, when I see the type of credits that we're approving and that with the loans that we're making, they still seem very attractive, right? We're in the 40% loan to value range. We've delivered, and when you look at relative, what we're delivering in the private markets versus liquid, I think on average for B credit, it's been 700 basis points of incremental spread, which is very attractive. You can look at the returns that B credit has delivered. You can look at the yield that it's delivering. And so I still think it's a really attractive place to be. We still feel like, the opportunity is great. But again, just like in real estate, you want to focus, one of the lessons learned over the years has been really focus on the best neighborhoods, right? We learned that through the GFC. We bought Hilton at the absolute worst moment in time. It was a great investment, great company, great neighborhood, great leadership. So in credit, it's the same thing, where there might be hazards is if you compromise. Go to smaller companies that might not be as strong, go into higher yielding opportunities in tougher sectors. We've been really focused on larger companies, which we have the ability to do given our scale. The average EBITDA for our borrowers in B credit is 200 plus million of EBITDA. The average in the market's 80, and that's proven to be more resilient. And focus on sectors that we view as better neighborhoods: IT and software services, business services, healthcare and healthcare services, insurance companies. I mean, that's where the majority of the capital is being lent in that business. So to us, stick to quality, stick to where you have advantage. With us, it's scale and better companies, better sectors. And we still see it as a really exciting, great place to be.
Fantastic. I mean, there's so much we could talk about.
We have a lot. We don't have time.
We haven't really got into data.
We didn't even talk about AI and data centers.
Yeah, I mean, that is just an absolute fascinating. We should maybe have a session on that another year.
Yeah.
But
I mean, that is the biggest theme we have going now. So it's a bit of a shame not to touch it. But yeah.
So we'll have to table that conversation for another time. But
something for next time.
Maybe let's wrap on this. So who has been the source of the greatest inspiration for you through your life?
Oh, okay. So I talked a bit about my dad earlier. Yeah. That certainly obviously planted a lot of inspiration. And look, I feel very, very lucky. And I think maybe it's part of the reason why I've been able to be at the same company for 27 years. And I do find that I can get inspiration just about everywhere or anywhere. I certainly get it a lot from my family. I wouldn't be at the same firm for 27 years if I didn't get it a lot from the people I work with. John Gray, Steve Schwarzman have been incredibly inspirational to me. But it's not just the two of them. I mean, to me, I go to work and the people that I work with are just this is going to sound arrogant, but are awesome. So I mean, I love the people that I work with. I genuinely get inspired by them. But I also part of the reason I love this job is because we do keep evolving. We do find new things. we're not going to talk about it, but AI and data centers and digital infrastructure and what that means for power and investing. I mean, this is so exciting, and you meet these people that start these companies, and it is so inspiring. Right. And then you say, oh my God, this is this whole nother world of opportunity that I didn't really know about, and to learn about that and to see what they built and what they've done, and to then to be part of that. To me, I feel maybe I'm very lucky. I've found this ability to still have a bit of awe and wonder. I'd also say I know I'm not going to keep you because we got a big guy coming up next. But these professional athletes are incredibly inspiring. I mean, Eli Manning. I mean, the guy is a true hero and legend, and not just because he won 2 Super Bowls and 16 seasons, but the guy showed up, right? 200 plus games in a row that he started. I mean that takes commitment. Wow. I mean, the commitment needed and the dedication and that that will to win, that desire to win. I mean, when I see these teams perform at these highest levels, it is incredibly inspiring. So I don't know. I find I get it everywhere, and to me, that's what makes life exciting and interesting, or one of the things.
Fantastic, Ken. This has been awesome, really great, and it's been so good getting to know you.
Yeah, excellent. Thank you, Alex. Thank you again at Prime Quadrant.
All right,
thanks. Oh God. That's amazing.
First of all, thank you for just saving me an Eli Manning introduction. Much appreciated.
Sorry, I didn't.
No, it's great. You actually saved everybody some time.
Oh,
but
God.
more importantly, I'll take it this.
Let's get in there.